A lot of data concerning Norway out at the moment, so how are things looking for the country? I'm joined today with Jack Allen from Capital Economics to find out. So Jack, Norway's manufacturing PMI dropped sharply in June to its lowest level in nearly 6 years, led by a steep fall in orders. Now in manufacturing production data out today, we're seeing a drop of 2.6%. Is this trend likely to continue, or is there a light at the end of the tunnel?
Well, the main reason for the weakness of the manufacturing sector recently has been the knock-on effects of lower oil prices. Many Norwegian manufacturers, such as shipping companies or firms involved in the maintenance and repair of machinery, rely quite heavily on demand from oil and gas companies. So if one sector struggles, so does the other. In the near term, we expect the manufacturing sector to continue to struggle. As you say, the manufacturing PMI points to an even weaker outturn in the hard data in June, and we expect oil prices to remain low. Our end 2015 forecast for Brent crude, for example, is just $55 per barrel. But further ahead, there are some reasons to be cautiously optimistic. Given Norway's dependence on oil, lower oil prices tend to be associated with a weaker exchange rate. And this should boost the competitiveness of manufacturers. So if they're able to reorientate their production towards overseas markets, they might be able to capitalize on the weaker exchange rate. But this will take time, so we don't expect to see manufactured goods exports provide a substantial boost to GDP growth this year.
On the upside, industrial production rose to 4.2% year-on-year and 0.7% month-on-month. How come we're seeing such a mixed bag of data, and what does it mean for the Norwegian economy?
Well, the important thing to remember is that the monthly data are volatile, so you shouldn't pay too much attention to a single month's figures. So while industrial production did rise 0.7% in May, and this was perhaps supported by the slightly higher average level of oil prices in that month, but this was nowhere near enough to offset the 5% decline in output in April. And so the big picture here is that today's data confirmed what we already knew, and that's that the declines in oil prices since last summer have led to a clear slowdown in the trend of industrial production growth. This is a reflection of the manufacturing data, which we've already discussed, as well as the direct impact of lower oil prices on the energy sector. All this means that we expect to see a slowdown in GDP growth from 2.3% in 2014 to around 1 to 1.5% this year and around 1.5% in 2016. This will suggest that unemployment will rise slightly, perhaps to around 4 to 4.5% for the year as a whole, and it will probably remain around that level next year.
Looking ahead to Friday and data out for Norway's inflation rate, what are you expecting from this release?
We think that Friday's release will probably show a slight slowdown in consumer price inflation from 2.1% in May to perhaps 2% in June. And we think that Norges Bank's preferred measure of inflation, which excludes the effects of tax changes and energy products, may have edged down too. Over the next 18 months or so, we think that inflation will probably fall further. This is largely a reflection of the slowdown in economic growth, which should put downward pressure on inflation. While we've not seen much of a sign of this so far in the hard consumer price data, survey evidence does point to slower inflation in the future. What's more, employment and wage expectations have weakened recently, pointing to a growing slack in the labour market, and again, this will put downward pressure on inflation. Admittedly, the kroner's depreciation over the past year has pushed up inflation, but we don't expect the currency to fall further, so those effects should probably begin to fade soon. And it's this combination of slower economic growth and inflation that leads us to believe that the Norges Bank will probably cut interest rates again this year. We think that's most likely to come alongside September's monetary policy report, where we think they'll cut their policy rate from 1% to 0.75%.
Well, that's all from Jack and myself for now. For more market analysis and regular updates, be sure to keep clicking back to Dukascopy TV. For now though, it's goodbye.